Well, good afternoon. Welcome, everyone. Before we kick off today's discussion, I'd like to thank the Orange County chapter of the Anderson Alumni Network for hosting today's webinar. Please stick with us through the call today, through the completion of Jason's presentation on China. Mary Huber from the Orange County chapter is going to join us to discuss three upcoming events in the first quarter. Specifically, there's going to be a wine tasting, a fireside chat regarding VC investing at big tech firms, as well as a potential in-person extension of today's virtual discussion with Jason. So again, please stick around for those important announcements from Mary on additional upcoming events at the conclusion of Jason's comments. First up, I want to say thank you to everyone for taking the time to join today's webinar. I'm Brent Ledbetter. I'm a 2009 FEMBA. I work in Orange County myself. Normally, I'm out of Newport Beach, but since COVID hit, my commute has been shortened to one flight of stairs in my house. So don't let the Anderson background fool you. I'm coming out of my house in Laguna Niguel here. So I work for Research Affiliates, as a firm I joined right after I finished at Anderson in 2009. At Research Affiliates, I explain the attributes of equity strategies we manage for firms such as PIMCO. More importantly, for the purposes of today's discussion, Research Affiliates is where I met our featured speaker. So Professor Jason Su is our featured speaker. He's the one you're here to listen to today. He is both the chairman and CIO, as well as the founder of Rayliant Global Advisors. Rayliant's a China-focused investment manager with offices in Irvine, London, Taiwan, as well as mainland China. Jason earned his BS in physics at Caltech, a master's in finance in Stanford, as well as a PhD in finance at Anderson, where, of course, as many of you likely already know, he went on to become a professor. Interestingly, I don't know if Jason knows this. I can't remember if I've told him this story, but the Fundamental Index book he co-authored is the literal reason why I joined Research Affiliates 12 years ago, coming out of Anderson. Before Jason founded Rayliant, he was a CIO at Research Affiliates. When I was at Anderson, I wasn't able to take Jason's class due to a scheduling conflict, but a friend of mine really enjoyed his class and recommended that I read the book. I really enjoyed the Fundamental Index book. It resonated with me. I joined Research Affiliates as a result, and I've been here for more than a dozen years. But with that, before we get started, Jason, you can probably describe your firm Rayliant far better than I can. Can you tell us a little bit about Rayliant and the challenges that you're looking to tackle there?
Yeah, absolutely. No, it's really good to see Brent after all these years. Now, Rayliant actually was birthed into the world from Research Affiliates. Rayliant was essentially Research Affiliates Asia. And then in 2016, I spun that off into a separate entity. And the reason for doing so was, China was starting to be too large to ignore. Everyone knows it's the second largest economy by GDP at some distant future. And it's not, I think, a if issue, but probably a when issue. It'll overtake US as the largest economy by GDP. And we're certainly seeing the different investors, particularly index providers, starting to include China in a much more aggressive way, just telling global investors that China needs to be part of your portfolio, whether you like China, dislike China. It is just too large and too big of a growth driver to ignore. So spinning out in 2016 was trying to get in front of that wave. Frankly, we actually have been in China, investing in China, doing quantitative research back in 2009. So it's been a full 12 years in China, understanding the market, understanding how it can be a diversifying option to the portfolio, and obviously understanding a lot of the issues associated with investing in China. So hopefully this conversation between Brent and I today, we're able to sort of tackle some of what I've discovered and really talk about a lot of hard conversation that needs to be had for anyone who's interested in accessing that part of the world.
Thanks, Jason. One final point I want to note before we kick off? While I'm lucky enough to be the host and I get first crack at asking Jason questions, we've got about 50 attendees right now. And we encourage everyone to submit questions. You can use the Q&A button in the bottom of your screen. We've got Jason's team on the line helping me filter through the questions, so please don't be shy. I'm a little spoiled. I get first crack at asking Jason questions, but I'm not the only one that gets to get Jason's views on topics of interest to them. So please submit your questions. So now we've got the lengthy preamble out of the way, I want to turn to the reason that we're all here and start to get some of Jason's thoughts on China. Jason's team was nice enough to put some material together for us. And one of the first questions that I have that's related to emerging markets as a group. Emerging markets, or EM, seems about as useful as a term to me as hedge fund, in that you're describing this very heterogeneous group as though it's one homogeneous entity, which it's not. China's economy is about as similar to Brazil's as Brazil's is to Korea, which is to South Africa, which is to say not very similar. So, Jason, my first question is, given how different these countries are, does it make sense to have just a singular EM bucket, or should investors have discrete allocations, particularly to some of these larger countries?
Well, Brent, to start off, EM as a bucket, you can say it's not terribly logical. I would say the only usefulness historically has been it's good if you're lazy, right? Instead of trying to figure out how all these things should be put together, well, someone just dumped it into one giant basket and say, all right, these countries are similar because, well, they're just not big enough, not advanced enough to warrant their own allocation, like a US, like a Japan. Now, that hasn't worked very well in the last few years because, one of the components, which is China, has gotten so large. It is now 40% of the EM basket, which means if China has a good day, EM has a good day. If China has a bad day, EM has a bad day. So in many ways, that diversifying basket is no longer very diversifying. So first and foremost, I think we're probably likely to see a case where China gets carved out of EM, just like we carved US out of the global portfolio, right? Otherwise, if US has a good day, the global portfolio has a good day, and you don't have a lot of diversification. Now, there is something that's rather interesting about China versus the rest of EM is it's actually particularly uncorrelated with the rest of EM, right? And part of that has to do with if you look at China, it's actually had a much lower correlation with developed countries. So its correlation with the US is about 0.3 when you look onshore China, whereas the rest of EM, its correlation with, say, US, with global developed markets are closer to 0.8. So China is somewhat unique in this case, that it's just significantly less correlated. And part of what drives that is because it's also a economy, while large, that doesn't have a lot of global capital, meaning you don't have a lot of global institutional money driving what happens in the market. It's mostly the domestic retail guys that's driving prices. And so the lack of global correlation is precisely because of this lack of integration between China and the rest of the world.
So I think that's a good segue to another topic we had touched on in advance, was this idea that the Chinese market looks different in terms of composition, in terms of the participants, from not only what we tend to see in most developed markets, but even other emerging markets. How does the Chinese market differ? What are some of the key ways that the Chinese market looks very different from, say, the U.S. market?
Well, first of all, I start with how China looks different from the US, and then we can also explore how China looks different from the other inefficient emerging economies. So versus the US, while China shares a similarity that it's large, it obviously is different from the US in that it's growing much faster. Right? If you look at GDP growth, per capita GDP growth in China, the last 15 years ran about 9% per annum. And over that same time period, while US was fast versus Europe, US actually, by comparison, grew at about 2.5% per annum. And if you look at corporate earnings growth, you're not surprised that the faster GDP growth, and at least in the case of China, has translated into corporate earnings growth, about 14% in the last 15 years in per shares earnings growth. over that same time period for the US, it was about only 5%. Right, so significantly slower. So on a growth rate perspective, China is very different from the US. Another aspect, which is less about the companies, but more about the market participants, 85%, this is as about 2 years ago, of China's trade volume is contributed by retail individuals. So people who are not particularly sophisticated, who are not particularly skilled or experienced in investing. Whereas, of course, in the US, prior to Robinhood, was closer to 5% retail. So you are not surprised if someone tells you Chinese stock market is less efficient. It's much more like a casino. Its price discovery function is less advanced. So big differences both in terms of the corporations that are available for buying, but also in terms of market participants. Now, a little bit about sort of the difference between China versus other emerging economies, which we might think, other emerging economies probably grew at the same speed as China, and perhaps might even have a faster rate of growth because China has gotten so big, right? You sort of expect, say, your less emerged economies, your LATAMs, right? Your Eastern European small economies may be able to grow faster, and that's always been a big paradox, which is most of the EM growth in the last 15 years has been actually dominated and driven by China. So not only has the GDP growth for the rest of the emerging markets been half of what China displayed, what's even more surprising is for the rest of emerging markets, the corporate earnings growth. So basically what you can buy in terms of listed companies, that ran at only about 2.5%, right? So significantly lower in China. So a fifth of what you see in China. And a lot of why that's been the case is those financial markets are just less attractive for companies to get listed, right? So a lot of the fast growing companies in the rest of emerging markets tend to stay private, whereas in China, the financial markets reward and provides enough liquidity enough that the fast growing companies are actually willing to get listed.
And I think a related question came in, looks like it was Edward asked the question related to, I'll bucket this in sort of the state-owned enterprises / float adjustment category. He asked, how do you adjust for, or how, I suppose, how should investors think about the risks posed by closely held firms as another point of differentiation there, large state-owned enterprises, how do institutional investors generally account for that sort of risk?
Yeah, and so this is true in China, and it's actually largely true for most emerging economies, is that there are a lot of state-owned enterprises when you look at listed companies. And that's a really interesting animal, right? If you think about sort of listing state-owned enterprises, it'd be like the US, right? Listing the post office and asking for other shareholders to chip in on the government incompetence. Hey, be as it may, other economies have managed to swing that trade. And so in China, as in the rest of EM, if you're concerned about buying state-owned economies, you're not crazy, right? There's a lot of good reasons why they're not super efficient and don't have a lot of growth rate. Now, the good news is oftentimes the market's not stupid either, right? In China, if you buy a state-owned enterprise, they tend to trade at very, very cheap multiples. So what you find is they're big dividend payers, right? So they're very cheap. They don't grow very much, but they pay a massive dividend because they're often big monopolies, either in tobaccos, in alcohol. And so you do find that in China. Now, what's more interesting is in China, if you look more carefully, there are the kind of bad, inefficient state-owned enterprises. So think of sort of the locally connected, locally controlled state-owned enterprises, where perhaps there's a lot more graft, a lot more sort of mismanagement. And then you got the centrally connected state-owned enterprise, which is sort of the face of the party, the face of the government. And they tend to actually be under great amount of scrutiny and tend to often have sort of the A team running the show. And they end up actually outperforming the market by about 2-3% per annum. So not all state-owned enterprises are bad. And certainly if you can buy them cheaply enough, it's a pretty good deal. Brent, you're on mute.
Sorry about that. You'd think after, year and a half into COVID, I would remember to unmute myself. Another question that we got, thank you again to everyone submitting the questions. Another question came in from Ian. I think this is also related to the topic in terms of how China's different. He's asking about a lot of the noise and news regarding China's plans for Taiwan. I'm curious to know, you've spent time in China recently. I'm curious to know what people in China think, and from a selfish perspective, what should be the important takeaways for investors.
Got it. Well, I mean, first of all, full disclosure, I was born in Taiwan. Actually, spent the first 10 years of my life in Taiwan. So actually, I do have a horse in this race, right? So I pay a lot of attention to what's going on there. And then we actually, Rayliant has an office in Taipei as well as offices in China. So we got people representing both sides, monitoring the situation. So I'd say first and foremost, right? A lot of people want to talk about sort of the China-Taiwan dynamic. And then there's obviously an interesting dynamic going on there. But frankly, the more important one is, China and Taiwan has a problem generally, if and only if China and US has a problem, right? When China and US see things the same way, there's no China-Taiwan problem, right? Because Taiwan basically says, okay, the US is not gonna, back me in an event of a lover spat between Taiwan and China. So I'm gonna stick pretty aligned with China and not make a fuss. And when we have ex-President Trump and now the Biden administration wanting to have more of an issue with China, then Taiwan has really become that pawn in a chess game where it is becoming an issue. Right? And so I would say, as an investor, don't confuse the Taiwan-China issue because most of the time it's masking a bigger issue, which is the China-US relationship issue. Now, if we say, right, just strategically, how would you handicap the risk of a military invasion, by China against Taiwan? Well, that's at least assume that for the time being, the Xi Jinping party is rational. Right? We know President Xi Jinping is likely to be in power for a extended period of time, for the foreseeable future. And in that case, right, Taiwan being such a useful pawn in this, game of risk between China and the U.S., Taiwan being such a good bargaining chip for both sides, there's really no reason to exercise that option, right? You can always have a conversation, and if conversation's not going well, you can threaten the cross-strait relationship a little bit. So really, there's really no rational reason to kind of pull out the ultimatum and exercise that move. And so my guess is it'll always be a bit of saber rattling, but it's just not rational for an actual full-out military action.
Great, thank you, Jason. And again, just a reminder to everyone: please submit any questions you have in the QA box. Next question I have: I know your team put together some material on valuations. Valuation seems to be an interesting topic globally, but particularly in China. You already alluded to the fact that China became more than 30%, close to 40% of the MSCI EM index, specifically because pockets of the Chinese market became very expensive, right? We have the FANG stocks in the US, China has their equivalent is the BATs, right? Baidu, Alibaba, and Tencent. But yet back to this idea of just lumping disparate companies together, right? We talked about emerging markets. These countries aren't all this homogenous. Similarly, in China, not every company is an expensive internet firm. Can you talk a little bit about valuations for A shares and just the degree of dispersion in valuations between maybe financials versus tech, and how that's changed over time, and how we've had just this explosion in valuation dispersion in China?
Yeah. So, well, first of all, Brent, unlike the U.S., literally today, the S&P 500 is sort of 80% dominated by your top 10, big tech names. So the U.S. literally is just tech stocks now. Everything else has just fallen by the wayside, become so small as to not matter. But in China, technology is about 15, 16% of the overall market cap. So it's got a pretty healthy diversification still, which is surprising to a lot of people. So you got a lot in finance, you got a lot in manufacturing, some boring stuff that we don't care about in the US anymore. And the reason for that is in China, everything is still sort of a growth industry, right? Because you still have a rapidly growing GDP. You still got China trying to rapidly transform itself from manufacturing into a consumption-based economy. So essentially, all the sectors are growing fairly fast. So by comparison, it's not so singularly relying on technology growth. But you are right, Brent, that technology has done really well in China, so well that growth has actually outperformed value stocks. So basically, think of tech stocks outperforming real economy stocks in China the last 2 years by close to about 100%. Right, and so obviously the growth stock and tech stocks have become quite expensive, which then, not surprisingly, the recent pullback, right? All of the recent pullback you saw for offshore Chinese stocks, onshore Chinese stocks, have been all in the technology sector, simply because they became way too expensive. Now, if you look at sort of the average valuation, just the median Chinese companies, they're trading at a multiple about 16, right? So a PE of 16. That number compared to the US, which is trading at about 36 to 40, depending on how you're computing the E, is about 50% of the valuation of the US. And that's also because China right now is still cheaper because there's just a lot of non-tech firms trading at fairly reasonable prices, and that it hasn't gone through a 10-year tech run that the US has. So from a valuation perspective, China is relatively cheaper to the US, and of course, Chinese non-tech firms are significantly cheaper versus the tech firms.
And next question, we've got a couple of related questions coming in through the Q&A and the chat regarding regulation and delisting of securities. And I think there's a relationship between these two questions. And so before tackling these, I think maybe it makes sense to spend a little bit of time. Can you just remind us of the differences between local A shares, Hong Kong listed, and ADRs or GDRs? Because I think that's going to relate to specifically to the delisting question.
Got it. Okay, so first of all, historically, if you want to buy China, it's quite confusing, right? You could buy onshore, which are called A shares, and that has nothing to do with like the mutual fund A shares, right? The onshore A shares are just companies that are listed onshore that you have to apply for what's called a connect program through Hong Kong to buy them. There are the Chinese companies that are listed in Hong Kong called H shares. So it's a small subset of Chinese companies, a much smaller subset that lists in Hong Kong. And then there are the ones that are listed in the US, which is an even smaller subset of Chinese companies who managed to pull that off and list in the US. So in the US are usually called the Chinese ADRs. Now, I don't specifically talk about Chinese ADRs because they're actually quite interesting. What most people don't realize is the Alibaba, the DD that lists in the US, it's actually not a Chinese company. It is generally structured as a Cayman shell company, which then owns a bunch of legal contracts that then controls the onshore Alibaba subsidiaries, that controls the onshore, DD subsidiaries. This is what's been challenged by both US regulators and Chinese regulators because it's technically a shell that doesn't own any business. It just owns a bunch of legal contracts and IPs as a way to, expatriate cash flow out of China offshore. In a way, it's just a clever iBanking scheme to circumvent Chinese foreign ownership rules and currency control rules. And so, both Chinese regulators are unhappy about that. And the US regulators said, look, you're not an actual company. You're just a bunch of legal contracts. I'm not even sure you're very enforceable. So the transparency and safety is not guaranteed. So, a lot of regulators, on both sides are going after the ADR structure. So we'll get into that. So basically, you got onshore A shares, which are very clean, right? It's exactly what you expect. American firms listed on the New York Stock Exchange. Chinese firms here listed in the Shenzhen or Shanghai Stock Exchange. Those are the A shares. The Hong Kong shares, not too unconventional. There are usually a lot of state-owned enterprises that list because those are sort of earlier listings. And then the ADRs are the weirdest ones, right? They're these shell companies that have legal rights to onshore cash flows.
Thank you. That's very helpful background. And I think that then with that background, we now specifically answer the question of how would you how would you handicap the sort of the probability of delistings, and to the extent that there are delistings, what does that impact? Does a delisting of an ADR have any impact on A shares? How do you think about that?
Yeah, so the ADRs are taking it from both sides, right? There's conspiracy theory. People say, the Chinese government's going after ADRs to punish Chinese companies that don't list in China but list in the U.S. But no, actually, a few years prior, it's the American regulators are trying to delist the Chinese ADR, saying they're just not transparent, and there's so much risk for investors who don't understand this VIE legal structure. So last Friday, Chinese regulator finally said, look, we're just going to force DD, one of the latest ADR listing, to delist and relist in Hong Kong, and they're going forward with that, and there's sort of clean path for how that's going to happen. Essentially, what happens is DD or any Chinese ADR would first of all relist or dual list in Hong Kong. Right? We Alibaba's already dual listed, right? And so it's very easy to dual list in Hong Kong once you've listed in the US. And then you could then convert all of your US listed shares over to the Hong Kong listed shares. So the only difference is different time zone. So you got to wake up at different hours if you're addicted to day trading. But other than nothing terribly interesting happens in that delisting and relisting, right? This is not where a company is so unprofitable, so out of compliance that it's being forced off of the exchange, right? It's just sort of converting itself from US listed to Hong Kong listed, and so there's no giant mystery in that. This is easily done, and nothing of value and I would say of liquidity gets lost in the process.
Great, thank you. And then I suppose the to your point, right, about the ADRs getting from both sides, sort of the flip side of potential delistings in the U.S. are the other side of that is potential increased regulation in China, whether it's for-profit education, deciding that the video game time is limited, which I don't have any issue with that one with my kids, but the question, I think Richard asked the question, which industries do you think might be next in terms of regulation? What sort of impact would you expect?
Yeah. Well, so there's a lot of things to talk about. So I'll sort of break them into parts. So I may be answering more questions than you're currently asking. So first of all, I think it's useful to explain regulators in China. So we may have this view, and then I grew up in the early 80s, and back then there's just a lot of movies where we sort of demonize or at least characterize sort of Soviet Union bureaucrats, right? There's some combination of incompetence and evil, right? And so it's sort of easy to map that to sort of Chinese regulators, right? And all communist bureaucrats must be incompetent and evil. Now I spent the last 12 years doing business in China, and then I've not found that to be at all true. In fact, probably the best way to understand Chinese bureaucrats is if you ever have a good Asian friend who has a tiger mom, or who himself or herself be a tiger parent, that's how you want to think of Asian regulators, right? They're very micromanaging. They know what's best, and they're a bit of a sort of disciplinarian, and so that's how you want to think about Asian regulators. And so oftentimes you'll see they're quite interventionist, right? So they're always putting forward new policy, trying to sort of micromanage, micro-adjust, and you should just expect that to be a constant in China. It doesn't come from a bad place; it just comes from that culture, right? The regulators act just like how they would act if they're parents. Okay, so that's how you really want to think about it. All right, so a few sort of funny regulations, right, to help you understand what's going on. So let's start with DD. Because obviously DD just got delisted, and it really got slapped in the face when it first listed. And again, conspiracy theory would say this is a Chinese company getting pissed off at the founder or something. Frankly, actually, this is all triggered by Tesla. So there was a Tesla crash in China, and then the transportation authority who was investigating the crash discovered, wait, Tesla cars record everything in the car and everything around the car, and sort of then stream that to US for analysis. If you own a Tesla in the US, you find that quite sensible, right? That's how you improve cars. But of course, for Chinese, that seemed quite scary. And so they very soon passed a law saying all officials are forbidden from operating a Tesla because they're afraid sensitive conversation or their whereabouts will be recorded. And they realize, wait, DD, which is of course the Chinese Uber, does the same thing, right? Just for passenger safety, they record everything in the car. So as a passenger, you don't mug the driver, the driver doesn't mug you. But of course, it's all being stored somewhere. Now, when DD was a Chinese company, Chinese government was perfectly fine with that. Now, once DD lists itself in the U.S., right, it sort of becomes a U.S. company. Then are all these data then sort of properties of, say, U.S. pension funds, right? In which case, that would be problematic for the Chinese government. So there's nothing more than that, right? They're just concerned about data security. So with regard to, say, the education sector, again, if you gone to school with a Chinese friend, how we all have perfect scores on exams. So I'll tell you how that magic actually happens. Is you go to a thing called cram school, and when you go to cram school, they don't so much teach you the subject matter. They just give you a giant test bank where if you do them, you will perfectly forecast anything that's going to be on your GRE or SAT, so you get a perfect score. It's not quite education per se. It sort of breaks the rule. And then so China decided to outlaw that because so many kids pay a lot to go to cram school and just skip normal school. And that was sort of messing up the entrance exam, the fairness of it. And it was such a big business, big profit. In fact, it was a big problem in Taiwan and also in South Korea and Japan. They never quite figured out how to deal with it. So China decided to pull out the ultimate showstopper and just say, all right, none of you can be for profit anymore. You're a non-profit organization now. So yes, these are when you understand the context, you kind of go, okay, I see what the government's trying to do. Now, of course, as an investor, right, your concern is fine. The government's trying to make rules that might make sense. But boy, this is a bad deal. If I bought shares in New Oriental Education Technology, right? If I bought shares in DD, if I bought shares in these gaming companies, and so yes, I think the Chinese government does have to sort of understand now that it's much more globally integrated. There's a lot more global capital investing in Chinese companies. It probably wants to signal a little bit more, and it probably at least should signal that it is just a more interventionist regulators, and that it's trying to impose a lot of sort of China-specific ESG. So I think of these as sort of its own social and governance type issues. And as it implements these ESG initiatives, it's going to create price impact. And as investors, it's just sort of useful to sort of understand where these regulations are coming from.
And a follow-up question that I think is directly related to the very next exhibit that your team put together. Given some of these regulations and crackdowns, what's been the impact specifically on the various share classes? And I think your team, highlighted the spike in volatility has really been felt offshore.
Yep. And again, easy to spin a conspiracy theory, right? The Chinese regulators are sort of protecting onshore and punishing offshore. That's sort of a correlation, is not causation. So it's just that the offshore companies are generally the tech companies, right? Because look, you can't list anything that's not tech in the US, right? If you're not tech in the US, no one wants to trade. You have no liquidity, no volume, no valuation multiple. So it's quite natural. Chinese companies that want to be in the US and list in the US are big technology names. So your Alibaba, right? Your DD, your Meituan. And so the end result of that is as sort of Chinese government is starting to try to understand how to regulate big technologies, and the data sensitivity, right? Do all these sensitive data on its own citizens become American properties? That sort of disproportionately hit the tech sector, and that then disproportionately hit the offshore sector, which are dominated by tech. So really, the reason why onshore firms have held up better is it's just more diversified. It's not so tech concentrated. The other reason why it's held up a lot better in terms of performance is the fact that it doesn't have this weird black swan risk of this VIE structure, right? Which is kind of quasi not legal. So that's another reason why it's sort of held up well. And again, for a lot of offshore investors investing in China, I think the amount of due diligence work that's gone into understanding what you're actually buying hasn't been very good. So you can't blame the regulators, right? Not the SEC. not the Chinese CSRC. In this case, you really got to blame yourself for not sort of reading the fine print, right? You're not actually buying the company, or you're buying a bunch of legal contracts.
That's right. Another question that's come in was discussing debt, and I know that you've got a specific exhibit you wanted to share on Evergrande, a company that's been in the news quite a bit. So, what are your thoughts in terms of the debt market in China, specifically for some of these developers, and the one of the follow-up questions? This was Tommy submitted this question. One of the questions that I really liked, or one of the components I really liked, was are money markets stable in China? So I think Tommy is remembering U.S. money markets breaking the dollar. So what are your thoughts on Evergrande, debt more broadly, the stability of money markets in China?
Got it. All right. So I'll link it all together. Right. We can start with Evergrande, the debt market, and obviously the real estate market, right? Because the last time, what really broke the U.S. economy was really the real estate sector that then created a global financial crisis. So Evergrande, the second biggest property developer in China, I mean, it's massive. I mean, it is just absolutely massive. It owes about $300 billion in debt. Right? That's a large number, of which about 20 billion, so actually quite a small amount, is owed to global investors. Now that's getting a lot of play, or a lot of attention, because that's all going to zero, right? So the amount of debt that's owed to global investors is likely to go to zero. The weird thing is the debt that's owed to the domestic investors are likely going to be fine, right? So again, you go, oh, well, this is not playing fair, right? So what's actually happening is, if you're sort of lending money in China, the credit market in China is very rudimentary. Let's just say it doesn't exist, right? I mean, it really technically doesn't exist, because you don't borrow on credit, right? I can't borrow on my good name because you trust me and I have a good credit score. The only way I can borrow money in China is I got to post collateral, and the only collateral people kind of care about is real estate, right? It's got to be a piece of land, it's got to be a building, right? Nothing else, really works. And as a result, all Evergrande's borrowing onshore domestically already collateralized by land they own in Shanghai, land they own in Guangdong, this building they're halfway completed. So as the government says, Evergrande, you have way too much debt. You can't borrow anymore. You got an unsustainable debt margin, right? You're not developing fast enough. You're not selling stuff fast enough. In fact, you're just sitting on properties expecting them to rise in price, and you're speculating in property prices. You're not developing, so you can't borrow anymore. So as banks sort of pulled credit from Evergrande, they're actually going to another developer and say, hey, look, this land is very valuable, right? This building is very valuable. Why don't you just go to Evergrande and buy it, because they owe me so much money and they can't pay me back. You buy it, I'll finance the purchase. You have a much better balance sheet, and we're all good. And this is why most of the debt onshore are being resolved that way. And so it's much more of a debt liquidity crisis than the fact that Evergrande has like bad real estate project that's falling apart, right? So the real estate prices in China are actually staying fairly firm. They're concerned that the new housing sales have been slow. The prices for new housing homes have been sort of flat. That's not because the market is cool. That's because the government says prices can't go up. So as a developer, you sort of have to sell at a almost not for profit prices. So you're not too incentivized to sell. That's why volume is low. But in the secondary market, where the government doesn't have that say, right? Prices are significantly higher buying a used apartment than a new apartment. So there's just no issue with property prices in China. So just a liquidity issue for Evergrande. In fact, it's really just going to be a bad deal for offshore investors, who just doesn't understand. If you lend money without collateral, you're like at the last in line. And when things go bad, you're the first one to get knocked out. And everyone onshore has, again, done their homework and realized, hey, if I'm going to lend money, I got to take a piece of property first. And so is this going to trigger some kind of collapse? No, right? The financial institutions are very savvy. They all have high quality collateral, and they're now getting buyers to take over that collateral and getting their money back. So it's going to take some time to sort of unfreeze a lot of these projects, and then things are going to be okay going forward. And the most important part, different than the U.S. global financial crisis, is there is not a sort of real estate price collapse that's happening right now, right? So you got solid fundamental, right? You got the underlying collateral with really strong price strength, and as long as that's true, there's no issue, no crisis.
Great, thanks. And thank you again to everybody submitting the questions. This is very helpful. I want to transition a little bit. Jason, you've done a great job, painting a picture in terms of the broad context in China. We got a question specifically from Ian, asked for recommendations in terms of specific ways to access the China market. So, you've talked about, onshore versus offshore and the important differentiation there. When looking onshore, what should investors keep in mind? Where does Rayliant place emphasis? What do you think about when you're, in the US, investors are always asking about passive versus active. What are your thoughts in terms of passive versus active in China? What's Rayliant doing? What would you recommend? Where would you recommend investors focus when looking to allocate to China?
Okay. Well, first of all, our book of business is a split between servicing big institutional clients, pension funds, insurance companies, and high net worth mass market. Right. So we have about just under $3 billion in ETFs are listed onshore in China, in Hong Kong, Korea, Japan, and also in the US. And our ETFs are different than most ETFs, right? Your Vanguard ETFs, your BlackRock ETFs, different from those. Our ETFs are active. Now, again, most of the time, you want a cheap, low-cost Vanguard type passive ETF because most markets, like the US, is very efficient. You're just not going to earn an easy alpha. But for China, being, again, I said, 85% retail traded, an inefficient market, an immature market, their active management can work and does work. In fact, the average active fund in China actually outperforms the broad market, outperforms the index by about 4%, right? It just tells you how inefficient that is, how easy it is to add alpha. And so that's what we offer, and that's what we recommend investors, right? You want to look at active options, so active ETFs, active mutual funds when it comes to choosing to access China. And you don't need to be too smart, right? You don't want to be doing your own research and picking companies. You want to pick something that gives you sort of broad exposure, because it's not just the tech firms that do well; it's really all the companies that do well. And as long as it's a largely retail market, accessing an active product is going to give you a advantage over the passive option.
Yeah, I think I think it's worth just emphasizing how potentially odd this exhibit looks to people that are used to investing in the US. The idea that active routinely beats in China, I think most everyone on the call knows that's not normally the case in developed markets, and you've explained with good reason, right, the unique idiosyncrasies of the Chinese market that would enable an active strategy to reliably outpace the benchmark. Let's see here. We're getting a lot of good questions coming in. Which one do we want to go with next? Jason, do you want to talk a little bit about, here's an interesting one. We got a question asking about the new Beijing Stock Exchange. What are your thoughts in terms of the new exchange relative to Shenzhen?
So the new stock exchange, the Beijing Stock Exchange, think of that as a stock exchange that primarily services your small micro cap names, right? Because the two existing stock exchanges, so Shanghai and Shenzhen, right? Shanghai is a lot more of the blue chip, call it a bit more value oriented, the bigger, older firms. Shenzhen has a lot more technology names, right? Think of that as more like how you think about NASDAQ in the US. Beijing stock market is now really focusing on much smaller growth companies. because the listing rules for Shanghai and Shenzhen requires companies to have been profitable for many, many years before listing. And after you list, you're required to make money, right? If you don't make money for a few years in a row, they actually delist you, right? And they realize, oh, wait, that's not how it works in the US, right? Because if they follow the same rule, Tesla, Amazon would have been delisted a long time ago, right? Because they're, especially Tesla, still figuring out a way how to make money. So trying to go, well, if we want to encourage really innovative entrepreneurial enterprises to list domestic in China, maybe we want to change this rule about having to be profitable first and needing to be profitable after you list. And so the third exchange in Beijing is meant to allow for those attributes. So what you're going to see is you're going to see a lot more much earlier stage growth companies listing in Beijing.
And given that there are going to be, nascent enterprises or an increase in the listing of nascent enterprises, does this just support the thesis even further that active has merit in a market? Because I would assume that the newer the company, the more likely it is to be inefficiently priced.
Absolutely. I mean, newer the company, the less data you have to go on, and the fact that its valuation is not yet dependent on profitability, right? These are all key factors in sort of noisy prices or even inability to price something. And so my guess is the Beijing Stock Exchange, it's going to have a lot more volatility, a lot more bubbles and crashes, and as a result, a lot more speculation, and on the other side of that, a lot more alpha for the more disciplined managers who can actually figure out how to price these stuff.
And in terms of trying to actually, to, as you said, to price this stuff, how does your approach to valuation in China differ from your approach to valuation outside of China?
Yeah, so you have to be very sort of localized when it comes to any emerging economies, right? Not just China. I think if you're investing in Taiwan and Korea, in Brazil, you got to be localized because first of all, everyone's accounting practice is just a little different, right? It's it may be international standard, but it's international standard with a lot of local flavors. You got to figure that out, right? And also the regulations are very idiosyncratic, and of course the degree of retail participation is very idiosyncratic. So it's unlikely, a U.S. research paper that finds a way that can successfully, detect undervaluation would work exactly the same elsewhere. And then so, a lot of the work we've done in the last 6 years is sort of localizing both well understood US research and say, well, how might they work in China? Do they work in China? And then also discovering a lot of sort of China specific things, right? Things that wouldn't make sense outside of China. And the one thing we found is in China, you have a lot more data. So when it comes to alternative data, China just has a lot more data. Now, data's not very long, right? Because it's a less mature market. But they have a lot of data because they started late. So it's very cheap for them to require disclosure and to store data. And as an economy that doesn't quite value data privacy as much, they make that much more readily available to anyone who's asking nicely. So there's a lot more data that you have access to study Chinese companies. So that part is actually quite interesting. A lot of alternative data. And also what's interesting is, a lot of stuff we teach, given that we're speaking to Anderson alums, and one of the biggest disappointment when I was teaching investment 101 is people would ask, does this stuff actually work? And I would embarrassingly say, no, while I test you on it, it doesn't really actually work because the US market's pretty efficient. So you're not going to find, a lot of free $100 bills sitting around. So other than being properly diversified, nothing else really helps you make money. And the funny thing is a lot of these things work super well in China because it's not as efficient. It's not properly priced into China. So all these techniques you learned at Anderson, when applied to the Chinese market, you actually get a much better outcome.
Great. Thanks, Jason. So yeah, what I'm hearing, just to sort of summarize, what I'm hearing is China is a unique market, right? you not only do you want to invest in local shares, you want to have a local presence. You want to understand that that unique market. That's specifically what you founded Rayliant to do. Right. Do you want to maybe talk just a little bit more about your specific process? I know that you mentioned that you're doing specific accounting work, or your team is doing specific work on the unique attributes of the Chinese market, but I don't believe you're doing fundamental analysis in the traditional sense. I think you're taking more of a quantitative approach. Do you want to talk about how that works?
Yeah, I mean, as a foreign manager going to China, clearly, you don't want to be competing against the local fundamental analysts, right? Because these are people who may have gone to school with the founder CEO, right? You're not going to have an information advantage over the local. Now, where we as U.S. managers, U.S. investors can have an edge over the local investors is, using quantitative techniques, right? The empirical finance that we teach at Anderson. These are things invented in the U.S. We still are considered cutting edge in terms of using machine learning, using big data technology to really study the data. So really taking the quant approach to invest in China does give foreign managers a unique advantage and an edge over the local managers and local investors. So that's very much our approach. And of course, you can't have too much hubris, right? It can't work exactly, right? You can't just take it out of the Anderson textbook and expect that to work in China. So there's a lot of localizing. So we hire a lot of Anderson alums who study in China first, then study at UCLA. Gone on to work at great firms in Orange County, at research affiliates at PIMCO, and then we hire them and bring them back to China, or they've gone back to China and we poach them away from the Ping Ans and the other big investment houses, and really it's with that global vantage point, that global experience, and taking those experience and looking at China afresh, that really gives us an edge, right? And then we don't look at China as just China, right? We look at China as, look, other economies like a Taiwan, like a South Korea, like a Japan, even the US have sort of traversed down a similar path, not identical, right? History doesn't repeat, but it often rhymes. And you can learn a lot about where China is likely to be. You can learn a lot about how big will the value premium in China be? How quickly might it shrink? How should you calibrate momentum strategies? How should you look at sentiment? How reliable are these accounting issues, and how much does Eric Sussman's forensic accounting techniques work in China, right? These you can take data points from other emerging economies, and that really help inform on what you should do in China. So that global perspective is quite valuable if you localize appropriately.
Great. And again, I just want to say thank you once again to everybody that submitted questions. And before we hand it back to Mary to talk about upcoming events, one of which will hopefully be an in-person discussion with Jason, specifically to cover many of the questions we didn't get to today. One final question I want to ask before we hand it over to Mary is specifically Jeff asked a question that I think would be a nice way to wrap up, just asking about your high level expectation for growth in China. What talk specifically about your strategy, and I'll get that up on. I don't think I'm allowed to say the ticker out loud, but I'll put it up on the screen for a moment. But if you could talk just briefly about your outlook for Chinese economic growth, that might be a good way to wrap up before we hand it back over to Mary.
Yeah. So, I mean, certainly China's growing a lot faster than the rest of EM. It's growing faster than the US, but it will slow down, right? Like any economy that's fast growing, it will slow down. Of course, what we care about is really the relative sort of growth advantage. So we continue to expect that to be the case, not just for the economy, but more importantly, for the underlying firms, right? There's just a lot more firms are in a growth mode, in a growth stage, versus where other firms are elsewhere, and then so I think that expectation is not just shared by managers who have exposures to China. It's really shared by global managers who are looking to allocate to China. So I think that part is true. But again, I think more importantly, this isn't just about buying growth. It's also buying growth cheaper, right? As I was talking to Brent, you're paying about a price to earnings multiple of 16 times when you're buying kind of a broad China basket and many of which are fast growing. And you're paying about 36 to 40 times when you're buying a basket of growth stocks in the US. So if you're going to buy growth, you can buy more growth cheaper for China, which is why a lot of our clients are sort of looking there. But more importantly, this is not about, a lot of people want to think about, will China outperform the US? It seems like if you're investing in China, somehow you're sort of betting against the US. And it's absolutely not the right way to think about things. What you really have is you got sort of twin global growth engine, right? US is growing fast, it'll always be an innovation leader. China will always be that fast follower, and both ways of delivering value and growing are equally valid and a little uncorrelated, right? One is really in innovation in original ideas, and one is really in innovation of sort of mass market cost reduction, micro refining an idea. And so these twin growth drivers, you should have both of them in your portfolio, especially because they're not very correlated these days. And then that is investment 101, right? You want to be diversified across things that are not correlated. So really, that's how I think is the right way to look at kind of US and China, the fact that they're in co-opetition, right? They're competing, which is why they're not very correlated. They're also collaborating, and they collaborate a lot, which means they can have a little bit of spat, but people aren't going to go to outright war when there's so much trade and so much value being co-created. So this co-opetition is healthy, right? We've seen that with US and Japan when I was growing up in the 80s, and then I think this is just sort of redux, and it won't be that different. So once you realize there's that co-opetition going, having both growth engines in your portfolio is the sensible thing to do.
Jason, thank you very much. As always, I learned a lot getting to talk with you today. I want to encourage anyone who has follow-up questions or would like to learn more about Rayliant strategies. You can go to Rayliant.com. You can email info@Rayliant.com to get added to the distribution list if you want to hear Jason's thoughts whenever there are events in China. He often shares his thoughts to their distribution list. It's a great resource to have to be added to the Rayliant distribution list. Jason, thank you again, and thank you to all the participants that spent the time with us today on today's call. This is a lot of fun for me. And with that, as I mentioned up front, I'll hand it over to Mary to talk about additional upcoming events for the Orange County chapter.
Well, I also want to start out by saying thank you, gentlemen. I really appreciate hearing the inside scoop, of China and what it's going to take to, an inside look at what's really going on. And I'm really excited for part 2 as well, because I think part 2, a lot more things will happen here in the next 3 months because of what's going on. And I think that'll be fun, and hopefully keep our fingers crossed here without the variants that we can have it in person. In Irvine, absolutely, yes. So thank you, gentlemen, very much, and really appreciate it. And I don't know if anybody actually saw what's behind you, Jason. And Brett, you never asked him about his little Star Trek thing here. There must be a little story behind this, so I'm going to have you tell that real quick, if you will.
The whole reason why I went to Caltech to study physics was I thought physics was like Star Trek. That's what I grew up watching, and I realized no, physics was actually significantly more boring than Star Trek. So my only connection to my physics background is Captain Picard's bridge now. Oh,
I love it. I love it. That's cool. That's very good. It's really neat too, because of all the stuff that's going on around us about space as well. So, well, again, thank you, everyone. We really appreciate you all coming on, and it is recorded today, so we'll be sending it out if you would like it. I just wanted to end and say we've got some great events coming up in the first quarter. Orange County chapter is back. We've been trying to, get people together, but it's been on a one-on-one basis or, some of these virtual events. We do have one slated for the end of January. Right now it's a virtual wine tasting, and I'll get you the date and times out, but I'm also trying to back it up with a virtual in case we have to go that route. We're looking at February with a fireside chat with a UCLA alumni about big tech venture capital, as well as the entrepreneurialism behind it and the OC system. And then the third one is the part 2 of our discussion here. But I would encourage, if anybody has a company that I'm not aware of and would love to have interesting subject matter that we could share with our alumni, to please come forward and email me, and I'll send out some more information about that as well. So happy holidays to everybody. Thank you again, and we appreciate all the participation because it always makes it much more lively. So, thank you.
Thanks, everyone.
Right.
Bye.
Bye-bye.